Well, we've had another day of dramatic falls for the oil price. Brent nearly dropped to $60 a barrel, WTI nearly dropped to $55 a barrel. Some of the consequences might not be quite as you had expected. Let's start with the most obvious victim, which is Russia. You can see now that the Russian stock market, when measured in dollars, is down more than 50% for the year. This chart makes it plain how painfully exposed to the oil market the Russian economy is. It's no surprise that the central bank has felt it necessary to raise rates yet again to defend its currency, plainly also raising the risk of bad things happening to its economy. A very obvious candidate to suffer from the fall in the oil price. But you're also seeing many other emerging markets that really shouldn't be in that bracket also falling significantly. Perhaps most dramatically today you saw a sell-off in Thailand, Indonesia, Turkey, countries that if anything might be expected to benefit from lower oil. And then there's the fascinating example of Mexico, very much in fashion since Enrique Peña Nieto was elected 2.5 years ago. Plainly, there are some ugly headlines about violence there. Also, it is an oil exporter. However, Mexico has all these factors that should be running in its favor, and it's positively exposed to the US. If the US does well, Mexico does well. Therefore makes it very difficult to explain why the stock market fell off more than 3% today, while it's down more than 20% in a matter of months. The best explanation is that we are beginning to see generalized capital flight from the emerging markets. The fund managers are selling what they can sell, which is the big liquid markets that have done relatively well. Therefore you see countries like Mexico and Thailand being sold off hard, even if they shouldn't necessarily be part of the equation. That all makes life very difficult for the Federal Reserve, who will be making an announcement on interest rates on Wednesday. The general expectation has been that the strength of the US economy would mean that they would hint very clearly that they will be raising rates sooner rather than later, perhaps by removing the phrase that they will expect to keep rates very low for a considerable time. Now, the latest data on industrial production and capacity utilization certainly would support that. It suggests industrial production is now back above the peak of the last cycle in 07. The capacity utilization is almost back there as well, i.e. that the great slack in the US economy would appear finally to have been devoured. That would be the classic condition to start gently raising rates again before inflation takes off. However, you now see this very alarming position where a number of currencies around the world are collapsing, where money is flowing back towards the US, where you've possibly seen the collapse of a bubble of some kind in oil. Is that really going to change the Fed's decision? It certainly makes inflation less likely. We've got a lot of a very much more interesting decision lying ahead of the Fed than seemed likely only a week or two ago.